Hello everyone, welcome back to another video. In today's lesson, you will learn to prepare the interest expense account. So you will have a question on the left hand side of your screen, and on the right hand side, you'll get to see all the workings which I'll go through step by step. What I need you to do now is focus throughout the entire lesson for an excellent understanding. So with that being said, let's begin. On 1 April 2016, Sunting Enterprise obtained a bank loan of $150,000 from OG Bank, which is repayable over 5 years starting from 1 April 2017. Interest rate is at 5% per annum, and the repayment of the loan and payment of interest are both to be made on every 31 March. The financial year of Sunting Enterprise ends on 30 June. So what we can understand based on the question is that this business took a bank loan of $150,000 on the 1st of April 2016, and this bank loan is repayable over 5 years, and it's repayable every 12 months starting 1 April 2017. The interest rate is 5% per annum, and every 12 months we are going to repay both the loan and the interest. Okay. So the first requirement of the question is to calculate the outstanding loan balance and the interest expense incurred for the 2 years ended 30 June 2016 and 30 June 2017. All right, so let's look into the workings on the right-hand side. All right, so we understand that we have taken the loan on the 1st of April 2016, okay? And the first financial year ends on 30 June 2016. So we are now looking at a time frame from 1 April 2016 until 30 June 2016. During this time frame, we know we have made no loan repayments, okay? Because the first repayment is on 31 March 2017. So in this time period that we are looking into, there is no loan repayment. The outstanding loan balance is the same loan balance of $150,000 at end of 30 June 2016. Okay, so the outstanding loan balance is basically the initial loan amount of $150,000 at 30 June 2016. Okay, so this is what we're going to fill in the table here, where at 30 June 2016, the outstanding loan balance is still $150,000. Okay. Now, what about the interest expense that we have incurred in between these 3 months, which is April, May, and June 2016? So we know the interest rate is 5% per annum, which we're multiplying with the initial loan balance of $150,000, and then we're multiplying with 3 over 12, which is basically converting this 5% annualized rate into a 3-month calculation, okay? Because 5% is for 12 months, so we are multiplying 3 over 12 to make sure that this is adjusted for 3 months, okay? And that gives us $1,875 as the interest expense incurred. Now, this interest expense of $1,875, I just want you to remember for now, is not going to be paid at 30 June 2016. Why is that so? Because based on the question, we know that we make the payment for loan and interest every 31 March. So at 30 June 2016, this amount for interest expense of $1,875, which relates to the 3 months of April, May, and June, is not paid. So this is an accrued interest expense, which is a current liability of the business. So in the table, in the column for 30 June 2016 for interest expense incurred, we are going to write $1,875 at 30 June 2016, and for the outstanding loan balance is also $150,000, which is equal to the initial loan amount because we haven't made any repayment yet at 30 June 2016. Okay? Now we are going to look into the next financial year. So the next financial year will start on 1 July 2016 and end on 30 June 2017. And we know that during this time frame of 12 months, we will make a loan repayment. And that loan repayment, based on the question, is going to be made at 31 March 2017. Okay? So at 31 March 2017, how much are we going to repay? We know the original loan amount was $150,000, which is paid every 12 months for 5 years. So if I want to find the loan repayment at 31 March 2017, I just simply divide the $150,000 with 5 years, which gives us $30,000 as the loan repayment. So after the repayment has been done, the loan balance at 31 March 2017 is the difference between the $150,000 initial amount and the repayment of $30,000, which is $120,000, being the loan balance that we have left at 31 March 2017. And this is also the same balance at 30 June 2017, because from 31st March 2017 until 30 June 2017, we have not made any further or more repayments, okay? So the loan amount left at 30 June 2017 is $120,000, which you can fill it in the table, okay? All right, now let's look into the calculation for interest expense. All right, so we have to calculate this interest expense in multiple time frames. And the reason being the fact that, during this financial year starting 1 July 2016 and ending 30 June 2017, we had transactions along the way where we have made loan repayment. Okay, so let's look into what's happening. So first of all, we want to find the interest expense from 1 July 2016 until 31 March 2017. Okay, and the reason we want to do it until 31 March 2017 is because we have made some loan repayment at 31 March 2017. So let's calculate this interest expense for the 9 months from July 2016 until 31 March 2017. So where we are starting with the given rate of 5%, which is an annual rate, multiplying with the loan balance of $150,000, which we had at end of 30 June 2016, and then multiplying with 9 over 12, because from July 2016 until end of March 2017, we've got 9 months in total, which basically adjusts the 5% annual rate for 9 months. And that gives us an interest expense of $5,625, which is for the 9 months from 1 July 2016 until 31 March 2017. Now, this $5,625 would be paid using funds available in the cash at bank account, okay? Right? Because at 31 March 2017, we are making 2 repayments. One of them is for the loan amount of $30,000, and the other one is for the interest expense that we have incurred, okay? So this would already be paid using the funds available in the cash at bank account, okay? So I just want to make that note here because we will be using this later when we prepare the interest expense ledger account. All right, now we need to calculate the interest expense from 1 April 2017 until 30 June 2017. But this time for the last 3 months, what we're going to do is multiply 5% with $120,000, which is the loan balance that we are left with after the repayment was made, right? And that $120,000 will be multiplied further with 3 over 12, because the 3 months that we need to adjust the 5% annual rate for, and those 3 months I'm referring to are the month of April, May, and June. So that gives us an interest expense of $1,500. And this interest expense of $1,500 is going to be unpaid at 30 June 2017. This $1,500 relates to the 3 months of April, May, and June. And this is unpaid at 30 June 2017, because as we know based on the question, we only make payments for loan and the interest once every year on 31 March. So there won't be any further payments in this year of 2017, but it will be in 2018, which is not the concern in this question, okay? All right, now we have got all our numbers for part A. What I need you to do now is prepare the interest expense account as required by Part B. And the interest expense account is going to be for the year ended 30 June 2017, which is basically the time frame we are looking from 1 July 2016 until 30 June 2017. Okay, so let's see what's going on. So here I have an outline of the ledger account for interest expense already prepared, which is the usual 5-column format that you're used to. And as we understand, the requirement in the question is to prepare this account for the year ended 30 June 2017. So which is basically the 12 months from 1 July 2016 until 30 June 2017. And all the relevant transactions for interest expense that have happened during this time are what we're going to input within this ledger account. Okay? Now, to begin with, let's see what's going on. So obviously, we're going to start the year with the opening balance on 1 July 2016. And that opening balance that opening balance is the unpaid interest expense from 30 June 2016. Okay, so I'm going to scroll back up and I need you to focus. All right, so let's scroll back up to the interest amount that we had calculated at 30 June 2016. All right, and that was $1,875. Okay, and we have made a note here that this interest expense was accrued and it was not paid at 30 June 2016. So this is an accrued interest expense, which we also call interest expense payable. This is a current liability for the business because this is a present obligation for us, right? And we need to make this payment very soon. So this $1,875 is going to be the opening balance on 1 July 2016. And because this is a liability, the opening balance will be recorded on the credit side. Why? Because all liabilities by default have an opening balance on the credit side. Okay, so we are going to record this opening balance of $1,875 on the credit side, which will give us a final balance of $1,875 credit. Okay, now what can we write in the details column? It's basically accrued interest expense, or we could just write interest expense payable. All right, so which gives away the definition of a current liability. All right. Now, what's next? We know the next transaction that happened was in the year of 2017 on 31st of March. And on 31st of March, we have made a payment for the loan and also a payment for the interest, okay? And how much did we pay for interest? Okay, we know we make payments for interest and loan every 12 months at 31 March. And based on the financial year that we're working with, the payment is going to be made at 31 March 2017. So at 31 March 2017, we will be paying $5,625 using our funds available in the cash at bank account. And this $5,625 is valid for the 9 months starting 1 July 2016 and ending 31 March 2017. But apart from this $5,625, we are also going to be paying that $1,875, which we had not paid at end of previous financial year at 30 June 2016. All right. So which means altogether we are paying $5,625 plus $1,875. So again, let me just do a quick recap. So the total amount we're paying altogether is $5,625 plus $1,875. This $5,625 is for the 9 months from 1 July 2016 until 31 March 2017. This $1,875 is for the 3 months from April 2016 until end of June 2016. All right. So altogether, 5,625 plus 1,875 comes out to be 7,500. So we are making a payment of 7,500. Okay, on 31 March 2017, which is the interest expense for 12 months ending 31 March 2017. Okay, so in the interest expense account, how can we record this? Whenever we're making a payment for interest expense, what's the journal entry? We debit the interest expense account and we credit the cash at bank account. Why are we crediting the cash at bank account? Because the cash at bank account is an asset account which goes down in value, and when assets go down, we credit it. Okay, and interest expense is by default debited in nature. So what we're going to do is within the interest expense ledger account, I'm going to record $7,500 on the debit column with the details being the cash at bank. Okay. All right. So how can we find the final net balance? So 1,875 credit from previous transaction, take away 7,500 debit, which is going to give us, I reckon, 5,625 debit because we have more debits than credits when we were subtracting. All right. So I'm just going to check if 7,500 minus 1,875 is in fact 5,625, which is the case. I've just checked. So therefore, it's correct so far. All right. Now, after 2017, 31 March, what do we have? So we have the end of the financial period on 30 June. All right. So on 30 June, we know we have got interest expense unpaid for the 3 months of April, May, and June, which was $1,500. And this interest expense being unpaid falls within the definition of a current liability. This is, in fact, an ending current liability balance. If you have seen our previous videos, we have discussed this many times. What we know that all assets by default should have an opening balance on the debit side and a closing balance on the credit side. And all liabilities have an opening balance on the credit side, which is what you have seen here before, and a closing balance on the debit side. So therefore, what we're going to do is show the closing balance of $1,500 on the debit side with the description being interest expense payable. All right. So always remember, all liabilities by default must have an opening balance on the credit side and a closing balance on the debit side. Okay. So what we're going to do, previously we had 5,625 debit as the final balance. We add 1,500 more debits to that because both are debits. So we get 7,125 debit. Okay. All right. Now, what do we have to do? We know that we cannot keep any numbers available in the expense account because all expense accounts must be reset to zero, which is based on the accrual basis accounting concept and the matching accounting concept, which calculates profit correctly based on revenues earned and expenses incurred throughout the year. And that's the main purpose of making the expense and revenue accounts zero at the end of the financial period before we start the next financial period. So what we have to do here is prepare a closing entry line. And the closing entry line is the amount of 7,125, which we are going to transfer to the income summary account. Or just to simply state, this is the amount that you'll be showing in your profit and loss statement or income statement or the statement of financial performance. When you show the total expenses column, you will be showing interest expense of 7,125. So what do we have to do here? So at 30 June, we prepare a closing entry, which we are going to transfer to the income summary account, which is simply also known as the profit and loss statement. And you're going to close this entry by reducing this expense of 7,125, right? So if you want to reduce this expense, we have to credit it because by default, expenses are debit, which means we have to show 7,125 on the credit column, which gives us a final balance of zero at 30 June 2017. Okay, so I'm going to show you the journal entry for this closing entry, which you can check in the previous video that I have uploaded. So the journal entry here basically works like this. So every time you want to close an expense account, any expense account, you will debit the income summary, all right? And you would credit the expense account. Because when we are crediting the expense account in itself, it basically means that we are reducing the expense account because expenses by default are debit, which means when they increase, they're debit. But now that we have to close it, which means we have to reduce it, we have to credit it. So that's why we're crediting interest expense against the income summary, which is debited. Okay? All right. Yep, that's all for this question. I believe you found value in this content. What I recommend you to do is always practice as many questions as possible. And you can check the other video that I have uploaded earlier for the bank loan and interest expense. And if you need tutoring sessions or monthly coaching help, you can check the link in the description to book a free call with me. You can bring your parents and we would have a chat and I'll help you prepare for your exams. So I'll see you in the next video.